Thank you for tuning in to the All Funds podcast. I'm Mike Schroeder. Today we're here with Skyler Steinke, and we're joined by Monica Blocker from Houlahan. Monica, thanks a lot for joining us.
Thank you for having me today.
This episode is brought to you by our friends at Richey. Richey provides audit and tax services for alternative investment funds. You could find the link to their website and contact information below in the description. Now back to the episode. Topic at hand. So this is part of our new fund launch series. It's meant to be short and sweet. Really, the idea here is for somebody launching a fund, kind of what are some of the service providers that you need. So Monica, we have you here to talk about valuation agents. So maybe just start off by telling us, what is a valuation agent?
Yeah, absolutely. So a valuation agent basically is an independent third party that's typically engaged by a fund to determine the fair value for illiquid, complex assets that they're investing in.
Very nice. I guess on that side too, who needs a valuation agent as we talk about it? And what does that kind of process and relationship look like with the fund manager?
Yeah, so any fund that invests in a liquid level 3 assets could certainly benefit from a valuation agent at some point in time. So common examples of these types of funds are private equity, venture capital, hedge funds that allocate a portion of their portfolio to illiquids, a lot of crypto and digital asset funds we've been working with over the last several years. And then more so as of late, a lot of these continuation fund vehicles that are these GP-led transactions that require a fairness opinion. And then as far as, your second question, what does the process look like? So it could honestly be as hands-on or as hands-off as the client would like. Some clients prefer more of a collaborative approach. They may be in fear of us coming up with a value that isn't in the realm of what they expected, while others just want to hand off the information to us and let us run with it and come up with, the fair value on our own. But, from start to finish, basically what a typical engagement looks like, we sign an engagement letter, we do an info request, they send all of the relevant information over to us. We take a look at that, understand the investment, the structure, the economics. We assess the relevant valuation approaches. We want to utilize as many as possible that are at our disposal, such as market approach, income approach, cost approach. So we evaluate, appropriate transactions that have happened recently, market comps.
Actually, this is good, Monica. I'm gonna cut you off there real quick. Maybe for the listeners, let's get into kind of like maybe first things first. Like, what is we talked about level 1, level 2, level 3 assets. Could you just break those down for us real quick?
Yeah. So level 1 assets, they're actively traded with observable prices. So think, for example, public equities. Level 2 assets, they have observable inputs, but not a direct price. So think like bonds or derivatives. Level 3 assets, they are definitely the most complex. So they are illiquid, and valuations rely on models, assumptions, and judgment. So think private equity, VCs. So valuations are mostly brought in for those level 3 assets.
Mm-hmm. That makes sense. Yeah. And when is it appropriate to work with folks like yourself from a valuation? When does that start? I mean, as I launch a new fund, am I thinking about that? Or later on, as I look at hard to value underlying assets, when do you guys get involved in the process?
Yeah. So in terms of, private equity funds, it could be as early as, the fund launch. They're typically more mature positions, so we have more methodologies at our disposal. For VC funds, it's typically reasonable to hold it at cost for, 9 to 12 months or so, barring any, changes within the underlying portfolio company. So for VC funds, I would say, a couple years in, that's where it kind of makes sense for us to come in for them.
Mm-hmm.
Okay,
cool. That makes sense. And I guess diving into that point a little bit more, so like a VC fund is a good example because I'm sure there's a lot of folks starting a VC fund. When it comes to valuing these assets, are they typically keeping them at cost for a couple years? And then when it comes to, let's say, a lot of times, obviously, these are going to be like businesses. How do you guys? Can you kind of give us the high level of how you would create that valuation for this asset?
Yeah. So, in terms of holding it at cost, a lot of VC funds did that for many years for an extended period of time. But obviously, there's been a lot of money that's flowed into the space, a lot more scrutiny around them. So, holding it at cost for an extended period of time does not equate to fair value anymore. You truly need to take into consideration any market changes, anything that's happened within that company, good or bad, new financing rounds. So it's very important to, that's where we come in. We help bridge the gap between determining the fair value, using current facts and circumstances to help the fund client get to that point.
Makes sense. And I guess in that conversation or discussion, as fund managers, VC funds bring you into that interaction, are you working with fund manager, auditors, administrators, all the above? How does that relationship
Yes.
coincide?
Yeah. So, as far as the fund itself, we're typically working with their fund finance team. So, think the CFO, controller, director of finance. We typically get on a call with their investment team at some point to understand their thesis behind making the investment. And then, as far as the admin, we could send the valuation report directly to them, but typically we send it to the manager first, and then they pass it along to the admin. The auditor, we do communicate with fairly often. We love to get on the same page with them up front, make sure that they're on board with our intended approach. And then, of course, once we've issued the report to the manager and they're in the depths of the audit, we help answer any audit questions directly with the auditor regarding any of our valuations, defending any of the assumptions, to really remove that off of the fund's plate and onto ours and streamline that process.
Makes sense.
I'm sure this question comes up a lot, so kind of a dumb question, but I'll ask it. Why doesn't an auditor or a fund admin do this role?
Yeah, it's from a fund admin standpoint, it's not a dumb question. We have been asked this before, and I'm sure Skyler, you've been asked this before, working at fund admins. Yeah, so fund admins, they calculate the NAV. They grab prices for level 1 and level 2 assets. They're not independent valuation experts. They're actually a great referral source for us because they can't do those independent valuations. So they send a lot of their clients our way that run into these issues. Whereas auditors, they're in charge of reviewing the valuations, challenging those assumptions, ensuring there's compliance, and they can't prepare the valuations themselves due to independence rules. As you know, a lot of audit firms, they have a valuation arm, but they can't do those valuations of the underlying portfolio companies for any of their audit clients due to those independence rules. So that's where we come in. We're independent, we're specialized, and we sit in between the fund and the auditor.
Yeah, that definitely makes sense. So in a way, you guys determine the value, the auditor signs off on the valuation methodology, and then the fund admin strikes the NAV based on that value that's already been determined.
Exactly. Yeah. One big happy family.
One big happy family. That's right. I guess another question, just relative to kind of what you're saying. What's the biggest mistake you say that fund managers make when they think about this process? What are they not doing correctly? What should they be thinking about?
Yeah, so I've been with Houlihan Capital for 9.5 years now. Since the beginning, my job has been working with funds and onboarding them. So spoken with hundreds of clients over the years. So there's definitely a few common ones that come to mind. With these VC funds, they tend to have very lean teams that wear a lot of different hats. And they tend to want to keep it internal to maintain the control and to not add any additional costs to the fund. But this puts a lot of strain on them, especially during audit season. Especially when the number of funds grow, therefore the number of the underlying investments grow, that's more valuations for them to do year after year. So this ends up bleeding into their weekends, into holidays, distracting them from doing, their other jobs that they're doing since they're wearing many hats. And then, another common mistake we alluded to earlier is the over reliance on stale transaction prices, especially with VC funds. They tend to hold their investments at cost or latest round for an extended period of time. And that doesn't equate to fair value GAAP reporting. So it's really important, especially after the 9 to 12 month mark, to really take a look at that investment and make sure that holding at cost is reasonable. And if so, documenting very clearly why.
And Monica, just like on that note, so when it comes to that, are you guys like asking for like that underlying company's financial statements, or what does that kind of high level process look like?
Yeah, yeah. A lot of times, what we hear from VC funds is they don't have access to information from a lot of these portfolio companies. So their hands are kind of tied because they don't have access to these financials. So in that case, the best we could do is do a market approach and make market adjustments to see what's happened since they made the investment. But yes, we obviously would love to have the financials from the underlying portfolio company. And that's honestly another common mistake that we see is these funds not requesting portfolio company updates on a consistent cadence. Quarterly is definitely best practice, being in contact with them frequently to get those constant updates.
Yeah, that makes sense. I'm sure too, which is, as you mentioned, just especially with emerging venture funds, the cost is a factor both
Yeah.
on, do I need to do an audit? Do I need an independent valuation process? Um, they don't, obviously, the cost is a factor for a lot of these folks, especially when
Mhm.
they're starting out. How do you talk about that process? Obviously, it's important to have controls and process and independence from the portfolio point of view. What happens with those discussions as you bring in new managers that are maybe on the smaller side that have to look at this? To your point, they're 2 years out and they still
Yeah.
haven't had that process happen. What are your thoughts there?
Yeah, and I
Yeah.
guess maybe to ask that a different way, like, what could somebody kind of expect to pay for valuation services? Obviously, this is going to fluctuate based on
Mhm.
maybe difficulty of the asset, size of the fund. Maybe throw a couple factors out there that could change the pricing, and kind of give us a ballpark of where, not only Houlihan, but maybe somebody at the low end, or somebody at the high end would fall.
Yeah. So in terms of these, smaller, new emerging managers, as I mentioned earlier, it may not make sense to bring us on right off the bat because holding at cost does make sense, especially for these VC funds for, a period of time. But once it's past that point and they're a few years in, we position ourselves as, look, we don't need to value your entire portfolio. Some of the positions are not very material. Where we could really add value is those most material positions that are stale. So a combination of, materiality and, most recent round, the staleness of it. So again, it doesn't need to be the entire portfolio. So just paying, the how we charge is per position. So if we just are valuing a couple of positions for them that are material, then won't be too high of a cost burden for them. And then in terms of your question, Mike, the cost for valuation services, we definitely tend to be more cost competitive in nature than a lot of the competitors out there, and we could tailor it to our client specific needs. But I would say, from us and some of the larger providers, I would say somewhere between the 2 to 10K range per position is probably fair. That captures most of the positions. And what goes into that is definitely the complexity of it. The more complex, the more time it takes on our end, the more approaches we're able to take for these valuations, the more time, so it gets to be more expensive. So on that high end, the 8 to 10K, you're thinking like preferred equity with liquidation or conversion features, convertible debt, options, warrants, etc., that type of thing.
Yeah, yeah, definitely makes sense. Um, what are your thoughts on, obviously, in the current environment, there's a lot of different asset classes, strategies. The lines of level two versus level three have been blurred quite a bit, I would
Mhm.
say, in certain cases. Having digital assets in the same portfolio as traditional assets,
Mhm.
illiquid tokens, vesting schedules, all these things. Were any nuances that people should pay attention to?
Yeah. So, in terms of the digital asset space, we've been in the space for, quite some time now. There's been new instruments that have come up and not exactly a lot of guidance on there on how to value them. So, our biggest goal and reason why we're mostly hired is to help the fund, pass audit. That's where we really add value. So I would say, some specific investments such as, tokens subject to a lockup provision. Several years ago, a lot of fund managers, they would assess a discount for those. Whereas, the pronouncement from a few years ago, the ASU 2022-03, it wasn't specific to tokens. It was for equities, but a lot of managers and auditors fell in that camp that it applied to tokens as well. So they're no longer applying a discount on those anymore. So again, this is not consistent from client to client. Many of our clients still apply discounts, and we're figuring out a discount for lack of marketability for these tokens. But there's definitely a lot of managers and auditors that are of the thought process that price times quantity is how it should be marked.
Cool. This is good. I know we're running up on time here, Monica. Just like, maybe like rapid fire, because kind of crypto comes to my mind. I've heard things in the past where it's like, even just valuing Bitcoin, there's so many different exchanges, whatnot. Are there any things on your, or like that should be like on a fund manager's radar in the crypto space, like perps, maybe even just spot crypto, just like any like things that you kind of throw out there?
Yeah, so we've been seeing a lot of these. We've been getting a lot of questions for these Safe Plus token warrants and whether there's any value in the equity. So I would definitely encourage folks to reach out to us. Our team is very well versed in the space. We'd love to talk through it. In the end, it does depend, especially on if there was supposed to be equity more so accrued towards the token upon its launch, or if there was going to be value in the equity itself post-launch. So that's where we've been getting a lot of questions as of late, is these hybrid structures.
Awesome. Monica, this has been great. Thank you for sharing this information to our viewers. Where could people go to connect with you and learn more about your services at Houlahan?
Yeah, so our website, houlihancapital.com. You could find me on LinkedIn, Monica Blocker. Email is mblocker@houlihancapital.com. Thank you so much for having me today.
Yeah, great to have you. And we'll make sure to include all your information and contact info in the show notes. Always good to have you on the show, Monica.
Thank you once again to our friends at Richey May for sponsoring this episode. If you're starting a fund, you need an auditor. Make sure to give our friends at Richey May a call and tell them we sent you.